Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, here we are. Sunny Friday in Vancouver and a sunny Friday, well, reasonably sunny Friday in the stock market. So, hey, nothing to complain about.
Walking on sunshine, as Katrina and the Waves would say. Bob, something, if you're in the lumber business right now, you must be laughing and smiling and skipping and jumping all the way to the bank. A year ago, last March.
These lumber guys may be making huge amounts of money, provided they have the inventory and can get it out. But I'm just looking at the May contract now, and this random length contract is for essentially the classic 2x4. And it is up to $1,300 per board foot. And at the crash a year ago in March, it was down to $275. And of course, what's going on mainly is that there's been a housing boom as people have been leaving the corrupt downtown cores of Democrat cities, such as New York or Los Angeles or whatever, and moving elsewhere. And part of moving elsewhere is moving into smaller communities, more remote communities, where there hasn't been enough supply of houses. So contractors are building them, and contractors are renovating them, and all that sort of stuff, which needs 2x4s right now. And I don't know about any supply restrictions. I haven't looked into it that detailed, but no, what we've been doing with commodities for this year is probably firm. Like, you can get a rally in copper to March, which we got, then another one into July, which we could be getting now. And then crude oil is often favorable through the summer. And then lumber does a very nice seasonal high at around June. And going straight up now is certainly heading towards what could be a seasonal high. And then what we want to look at, Jim, is that these key items, lumber can have a seasonal low in October. Okay? And then copper maybe around November. And then crude oil, perhaps around January, February. And then the other thing is the old saying in the financial markets, sell in May and go away. And you have probable buoyancy into May or June. And then if there's going to be any liquidity problems, they would be discovered in October, November. So, hey, we're looking maybe at a classic year.
Well, with this lumber thing as well, for the people who can't get out because they've been locked down, they're improving their homes. They're finishing the rec room they probably started on 10 years ago and decided to finish it off. But when the prices reach this high, what's that going to do for future projects? I know a survey found the average cost of building a house in the U.S. has gone up roughly $25,000. Is that going to put brakes to this housing boom, or with low interest rates, are people going to say, so what if the house costs $25,000 more, I can still afford the mortgage?
Well, this is it, but with the long rates going up, mortgage rates have been going up. No, but Jim, it's a classic market move. It goes until it quits. And the only thing you can do on one of these moves is to have the technical tools that work, like give you the upside exhaustions, or as we also have another tool called give sequential sells. Well, of course, we're watching lumber like this, watching for the telltale. But what any powerful speculative move goes until it exhausts itself. The bidders just quit. They're exhausted. And at that point, the side that provides the supply gets everything cranked up, and even uneconomic sawmills and whatnot are started up. So I'm telling you, although the price change is without precedent, it is still a runaway speculation and will exhaust itself. So we're watching for it. And also, something like this is part of a broad economic boom that, and this one was interrupted by authoritarian governments with their lockdowns because of COVID. This was control freaks heaven, and they really put in the control. But it shows how powerful a major financial bubble is, because after the whack last year, you've been on a financial bubble. Absolutely incredible. And then in past financial bubbles, you've always had a boom in the economy, which we're getting. So despite the horrendous employment numbers. So there is a boom going on. Now here is the way that these great financial bubbles have worked in history, is that because the financial side is so dominant, when the financial side fails, it takes business and economic activity down with it. And even, that shows up all the way back to 1720 with that great bubble. But when one wants to have economic numbers with it, the 1873 bubble completed in New York in that September. And then the National Bureau of Economic Research, NBER, reconstructed the business cycle back to 1857. And they determined that that recession started in that October. So the high for the bubble in September, and it was a dreadful recession. As you get post-bubble recessions, are very severe. And then you go to 1929, where New York peaked in early September, and that recession was deemed to have started in August. So then now usually in the business and stock market cycle, the stock market leads the economy by 10 months to 12 months sort of thing. And this is why the economists have put together what they call leading indicators on the economy, and they include the S&P 500 in that. But then when you get into the world of financial manias, it's instantaneous. Like even 2007, which was a terrific bull market, but in looking back on it, it didn't quite have all of the features of a classic bubble. But the New York market peaked in the middle of October, which is close to September, and that recession started in December, which is close, not the usual 10 to 12 month lead. So this is where watching the stock market now is very important, and it's becoming speculative enough that there will be a failure. And then one should know that once the failure starts, the recession would start virtually with it. So it's going to be interesting.
We'll have more with Bob Hoye right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Bob Hoye. Bob, what camp are you in? Are we headed for hyperinflation or deflation?
Oh, well, I know the answer to that one, Jim. We are in hyperinflation, but the inflation is in financial assets. So when you take, like in Germany, the 10-year note, which got down to almost minus 1% nominally, never happened before in history. And the way yields decline is with bond prices going up. So you've had hugely inflated bond prices without precedent. And you've had a hugely inflated stock market at valuations that are without precedent. So you get into terminology here, and most of the financial and policy-making world and the world of financial letter writers has only one definition of inflation, and that's what was happening in the 1970s, where you had the whole cost of living soaring, going up, and in most cases faster than wages were going up, and they are associated with great distress. And then those kind of inflations eventually blow out, and then are followed by inflations in financial assets. And this is something that the economists don't understand, central bankers don't understand, Wall Street doesn't understand, and there's a whole gang of commodity permabulls who don't understand it either. And so here is the pattern that since the first great bubble in 1720, a huge global boom in commodities had peaked in 1711. So approximately a decade later, the stock market blows up and goes crazy and crashes, and it was followed by a long contraction. And then every great bubble since, and including the one I talked about, 1873, the huge peak was in commodities inflation was 1864, 1865 there. So about a decade later, you had the big stock bubble and the failure. 1929, the commodities reached a screamingly huge peak in 1920. And I looked it up recently, Jim. The U.S. rate of CPI inflation got up to 24% annualized. And then the crash. And then, and I looked it up again, the rate of inflation in 1921 got down to minus 16%. So the whipsaw in commodities was huge, but the central bank then was paralyzed by the deflation that followed 1920. So the Fed kept an easy policy, not wanting prices to go down, not understanding that it was time for a financial mania. So their ease in order to boost commodities boosted the stock market to 1929 and the subsequent crash. Now, for most of the last big peak in commodities was 2011, and you had gold and silver to a speculative rush that was absolutely incredible. And you've had the hard hit to that, but then you've had a financial bubble since. And you've also had, through most of the decade, the Federal Reserve concerned that inflation would get too low and set off a deflation. And I think I saw a headline recently about the head of the Fed saying that they were, more worried about deflation than inflation. And so here you've had the Fed ignorantly worried about deflation and keeping the pumps going and injecting money into the credit markets through a bubble in financial assets. So the Fed has done exactly what it did during the 1920s. And so here we are. So the debate is that the ease that the Fed has been doing, combined with the new socialist government in the U.S., and even an inflationist at the Treasury, that they're all going to go even crazier, and now we're going to get what we understood in the 1970s, inflation. But hey, I'm staying with history, and it shows that once the inflation in financial assets is over, all prices go down except for the real price of gold. So, and what we're here now, Jim, is that if inflation was really on, the T-bill rate would be going up, and the T-bill rate is headed down, is almost down to zero. You would have, and then back when when the boom has been in commodities and inflation items, the stock market has been an underperformer. So what you have now is the financial market's the outperformer, and the commodity markets are the underperformer. But they've had a good rally, and as I said earlier, we were up, copper became overbought and getting overbought again. Crude oil became overbought. So the action in commodities is close to maxing out. We figure that after mid-year, after August, if you want to include crude oil, the key commodities will be heading south in a big way.
Well, what I want to know, though, back in the 70s, Bob, the wages and prices were going up. Maybe wages weren't quite keeping up, but wages were going up. Right now, we have a situation where financial things are going up and lumber's going up, commodities going up. But people who live in the real world who lost their jobs, obviously, when they come back to work, they're not going to be asking for pay raises. Is this just going to widen the gap between, I call this a 40-20-40 split. We have 40% of the people were never laid off during the pandemic. They kept their jobs. They're doing well. They're the CEOs of these online companies getting orders that people don't have to service people in person. But if you work in a toenail salon or you're a hairdresser or a bartender, you've lost your job or you have radically reduced numbers. Is this just going to widen that gap between the rich and the so-called working poor?
Oh, yeah, and the financial mania, those who know how to game the financial markets are just making huge money. Those that are not in the financial markets are either getting by or unemployed. So, but history shows that this has happened before, and always when you're in it. But I want to go back to the 1970s. I was in the financial markets then, and only just beginning to become a financial historian because of the curiosity about the financial markets. But during the 1970s, the economic side of the equation, we're all discussing about whether the inflation was caused by wages. It was cost pull or wage push. Whether cost, that kind of thing. And then somewhere in the later part of the 70s, the economist Friedman, he said that inflation is always related to excessive credit, i.e. the Fed, and it was like a breath of fresh air went through Milton Friedman, and like a breath of fresh air went through the whole of the system. And so it wasn't until the late 70s, going into 1980, that investment fund managers finally began to understand what inflation was about, and they started adjusting portfolios, maybe talking about going to 20% cash and finding ways to get long inflation items, and that was at it peaked in 1980. As a matter of fact, by that time I'd done enough research that in 81 and 82 I was aiming the research towards financial institutions, and this is before PowerPoint, but one of the slides I had was that no matter how much the Fed prints, stocks and bonds will outperform commodities. And it was highly controversial then, and it's highly controversial today. Even after all of the history since damn near 40 years, they still have trouble figuring out the difference between inflation in financial assets and inflation in tangible assets. And without that history, I could not have made that claim that no matter how much the Fed prints, commodities would underperform financial assets. And that has been the game essentially since. So then, using that same history, I could modify that statement and to no matter how much the Fed prints, all asset prices are going down. And that's easy because that's what happened after 1929 and what happened after 1873. God, I've got a chart of mining and smelting stocks from about 1870. And it reached a peak in 1872, just off my memory. And then it went into a 20-year bear market. And of course, during that boom, base metal prices were up, and the mines and smelting sector was making a lot of money. It was an important sector. And then, as I said, it went into essentially a 20-year bear market. So all of the inflation bulls in the 1870s ultimately became extremely disappointed. And I think I would say the same thing now. All of the inflation bulls now that have come out of the woodwork are going to discover a disappointment. So,
Bob, is it time to call out our governments in Canada and the U.S. for the crap that they are for changing the way inflation is calculated? The Chrétien and Bush governments agreed that the cost of housing and fuel should not be included in the cost of living. And I went, well, as long as you don't have to heat your home or drive anywhere or take transit or build anything that it requires energy or live under a roof somewhere, yeah, that's an accurate thing. And so since then, inflation has only been 1 or 2% a year. But yet, I can tell you that the cost of groceries has certainly gone up a lot, especially this year.
Oh, yeah.
But the government still insists. But, inflation is under 2%. John Williams, who does shadow stats, he said the real inflation rate is 7 to 9% a year. But why doesn't the government want to acknowledge that? Is it because they'd have to increase your pension 7 to 9% a year?
Well, this is why they changed it with Clinton.
Yeah.
Is they changed the calculation because the state of paying all of those people on dependents on thing was tied to the rate of inflation. And then there was also a demand to get government costs in line in the when Clinton was in office, thanks to the Republican majority in both houses. So what then is when the cheat on calculating the rate of inflation really began to change, because they were cheating those who were dependent upon an inflation-adjusted cost of living thing. So that's when it began to change. But I remember in the early 1970s, in the first energy crisis, you had then what was called the wholesale price index. And then whatever the numbers were, it did a double in about 3 or 4 years. And people were talking about it. The wholesale price index has doubled. So what did they do? Changed all the numbers and called it the producer price index. But they practice inflation, inflating credit, and then the academics didn't want to get blamed for soaring prices and the distress that went with it. So then they dreamed up this concept called inflation expectations. So inflation wouldn't happen until the public suddenly got inflation expectations. Well, man, that's tautology, and it's absolute garbage. But it was a step to remove policymakers and central bankers from chronic inflation. And yet they know themselves that continuous expansion of credit will eventually drive prices up, and you end up with, as I've said, two kinds of inflation, not both at the same time. You end up with a decade of inflation like the 1970s, the old and kind of inflation, and then you get the inflation that still nobody understands, which is inflation in stocks and bond prices. So lots of, governments will cheat wherever they can, and governments cannot be reformed from these habits, but they can be made less of the economy. And I think that we're going to go into a great reformation whereby ordinary people look at what governments have been promising and look at what the results are. This then, Jim, gets us into the subject of benign popular uprisings, which we can do a special on at another time.
We'll have more with Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, Bitcoin mania has swept the nation. Actually, it's been around quite some time because I remember my birthday 4 years ago and everybody was saying, do you have your Bitcoin? You got to get Bitcoin. It's at 20 grand. Well, now it's up around 63,000. And a lot of people are saying, this thing, it could go to 72. It could go to 100. It could go to 1 million. Is there any stopping? And not just Bitcoin. I would say cryptocurrencies of any kind, because apparently about 7 a day are being created.
Oh, it's a mania.
And when you have a mania, does it mean it could be like tulip mania, where it's the big hit one day and this goes away, or because people are now married to their cell phones and love to do their trading by phone, is this phenomena going to stick with us? And will governments try to put a lid on it?
Oh, no, governments never try to put a lid on a speculative market, particularly now, because they know that if they get deflation, the game's all over. So the other thing is, in the calculation of the consumer price index, they never include taxation, which is a basic cost.
So, what's your angle on Bitcoin and these other cryptos again? I was saying off air, why don't we just create the Jim Bob coin and see how that works out?
Anybody can do it. Well, I got here a headline, Bitcoin ETF drumbeat gets louder, da-da-da-da-da-da. So all of them going on. And it is, no matter what magic name you put on it, it's a speculative fury that is on now. And I learned from the old Vancouver Stock Exchange decades ago that so long as the price of the stock is going up, the public will believe the most preposterous things. And once it breaks, suddenly the belief is gone.
So the cure, I guess, as they always say, the cure for high prices is high prices. When these things get too expensive, people will bail.
Yep.
Bob, thank you so much for chatting with us.
Jim, good to be with you, and look forward to next week.
As you know, Bob loves to answer your questions. You can send them to info@howstreet.com. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. Bob, thank you so much for being on the show.
Hey, anytime.
Bob is a market historian. He's the chief investment strategist for chartsandmarkets.com. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at talkdigitalnetwork.com. HowStreet.com Radio is a production of How Street Media Incorporated.